So, how much does something cost? Seems like a pretty simple question, doesn't it? Well, for a business that's buying and selling, thousands of items, the answer is, actually, it's pretty complicated. In fact, how a company decides to answer that one question can completely change how profitable it looks on paper. Let's just dive right in with a simple example to see what I mean.
Okay, so take a look at this. It's a super simple scenario. A store buys a shirt for $10, then an identical one for $12. Then they sell one of them. So what was the cost of that shirt they sold? Was it $10? Or maybe $12? Or could it even be $11? Well, the crazy part is, depending on the accounting method you pick, any of those answers could be totally correct.
So here's what we're going to do. We're going to unravel this whole inventory puzzle. First, we'll look at the ideal method. You'll see why I put that in quotes. Then we'll break down the 3 big assumptions companies use to figure this stuff out. We'll see how it all hits the bottom line, and we'll wrap up with why this is all a really big strategic choice.
All right, so first up, let's talk about the ideal way to do this. I mean, in a perfect world, right? We wouldn't have to guess or make assumptions at all. We know the exact story of every single item that walks out the door. This perfect world scenario has a name. It's called the specific identification method. And it's pretty much exactly what it sounds like. The best example? Think about a car dealership. Every car has a VIN, a unique serial number. So when you drive a car off the lot, they know the exact cost of that specific car. They can match that one sale to its one precise cost, no guesswork involved. Now this is great for those big-ticket unique items. Cars, heavy machinery, maybe some fancy custom furniture. The pro is a no-brainer. It is the most accurate method, period. But you can see the problem here, right? Just imagine a big hardware store trying to track the specific cost of every single nut and bolt. It'd be an absolute nightmare. For most businesses, it's just not practical or cost-effective. Okay, so if you can't track every single little thing, what's plan B? Well, you have to make a logical assumption. You have to decide on a story for how your costs are flowing through the business. And this is a really, really important point. We're talking about a cost flow assumption. This doesn't have to match the physical flow of the actual items. Let me say that again. It's an assumption about which price tag you're using for your accounting, not necessarily which physical shirt just left the shelf. All right, the first and maybe the most straightforward way to do this is the average method. This approach basically says, hey, let's just throw all the costs into a big pot and stir. It kind of smooths everything out. It takes all the different prices you paid and calculates one single average cost for all those identical items. Okay, so let's see how this plays out for our example company, Entity A. They start out with some units that cost them $20 a pop. But then, look what happens on March 1st. They buy more, but this time, the prices jump to $32. So what does the system do? It immediately averages those costs together, creating a new blended cost of $22 per unit. And from then on, every sale uses that new average, at least until the next purchase comes in and changes the average again. So, after all the buying and selling is done, the bottom line is this. Using the average method, Entity A's total cost of goods sold comes out to $2,300. Got it? Okay, lock that number in your brain. That's our first answer. Okay, next up we have FIFO. That stands for first in, first out. And the logic here is super intuitive. You probably see it every day. Just think about the milk at a grocery store, right? They always push the oldest cartons to the front because they want to sell them before they expire. FIFO does the exact same thing, but with your costs. The first costs that came in are the first costs that go out.
So let's apply this to Entity A. With FIFO, they're assuming they sold all their oldest, cheapest items first. They basically burn through that entire first layer of inventory, the stuff that only cost them $20 a unit, before they even start to account for the more expensive stuff they bought later. And what's the result? $2,320. Now hold on. That's $20 higher than the average method. Let that sink in. We're talking about the exact same business, the same purchases, the same sales, but we already have a second, different answer for the cost.
And that, of course, brings us to our third method, LIFO. Last in, first out. The best way to picture this one is to think of a stack of clean plates next to the sink. You wash a plate, you put it on top. You need a plate for dinner, you grab one from the top. The last one you put on the stack is the first one you take off.
For Entity A, this means when they make a sale in April, they pretend they sold the items they bought most recently. That's the expensive stuff from March that costs $32 each. They're taking the costs right off the top of the stack first.
And the final number using LIFO? $2,260. So now we have a third different but totally valid cost. I mean, how wild is that? 3 methods, 3 different costs, all coming from the exact same set of facts.
So we've got 3 different answers to the same simple question. You might be thinking, so what? Who cares? Well, this matters a lot. Because this choice isn't just some boring accounting detail, it has a massive, direct impact on the story a company tells with its finances. And that story affects everything: its stock price, how much it pays in taxes, how investors see its overall health.
And the whole game completely changes when you add one little word into the mix: inflation. During any period of rising prices, the choice between FIFO and LIFO stops being a simple accounting preference and becomes a high-stakes strategic decision.
Okay, so here's where it gets really juicy. When prices are going up, LIFO takes your newest and most expensive costs and matches them against your sales. This gives you a higher cost of goods sold, which means you report a lower profit. FIFO does the exact opposite. It uses those old, cheap costs, which makes your profit look way, way healthier.
So you have to ask yourself, why on earth would a company choose a method that makes them look less profitable? Well, the answer comes down to one word: taxes. See, a lower reported profit usually means a lower tax bill. And that right there is the classic trade-off. Do you go with FIFO to report higher profits, make investors happy, and maybe boost your stock price? Or do you go with LIFO, report lower profits, and pay less money to the taxman? It's a huge decision.
And this really brings us to the heart of it all. This isn't just about accountants following rules in a textbook. It's about a company actively choosing the rule that best fits its overall financial strategy. And here you can see it all laid out side by side, based on the different assumptions we've talked about. And believe it or not, there are even subtle variations within them. The exact same business activity can crank out 5 different totally valid results. Same purchases, same sales, but different costs and different inventory values on the books. Each method is telling a slightly different story.
You know, the official guidance says the goal is to pick the method that, and I'm quoting here, most clearly reflects periodic income. But here's the thing. What one person thinks is clear might look totally different to someone else. And right there, in that little bit of wiggle room, is where a whole universe of financial strategy lives. Which leaves us with one last, and I think fascinating question to chew on. The next time you see a company announce its big quarterly profits, just ask yourself this: are you looking at a simple, objective fact? Or are you looking at the carefully calculated result of a very strategic choice?